Chapter 7, Putting It All Together. A man who has committed a mistake and does not correct it is committing another mistake. Confucius. Never forget that risk, return, and cost are the three sides of the eternal triangle of investing. John C. Bogle, founder of Vanguard, the world's largest index fund manager. Let us return to our protagonists, Mr. Talwar and Mr. Sangvi, and see how the knowledge from the preceding chapters of this book helps them. Essentially, what this book has highlighted is that investing for long periods of time in high quality portfolios leads to with a higher weightage to high quality small cap companies going down to while ensuring that you don't pay too much by way of fees going down to and avoiding investment traps like real estate and gold should lead to significant and sustainable wealth creation. Mr. Talwar piecing it together for a secured life. On a Saturday afternoon, when Nikhil sat down with Mr. Talwar to assess his financial position, they ended up spending more than 3 hours. Several cups of tea were downed and plateful of pakoras were consumed. As the discussion progressed, Mr. Talwar realized that he had never conducted an exercise like this before. Though he broadly knew his goals, which were primarily his responsibilities, it was only after he put them down on a sheet of paper that he realized that even the smallest of his goals or ambitions had a monetary cost which would not be fulfilled automatically. In short, every goal needed a plan. There are several elements in financial planning, but the critical element is the time value of money. If you have to buy a car 5 years later, which costs rupees 10 lakh today, you will end up paying more than 16 lakh rupees if we assume a 10% per annum increase in the cost of the car. So, if you had earmarked rupees 10 lakh to buy a car and earned a 5% post tax interest on that money, your money pot would have grown to rupees 12.8 lakhs, that is rupees 3.2 lakhs short of the amount you need to buy the car 5 years later. This predicament would have arisen even though today you had exactly the amount you need to buy that car. The root cause of the problem here is inflation. Unless we plan carefully, thanks to the inflation, the prices of the things we want to buy in the years to come will grow faster than our ability to compound our savings. Chemistry teaches us how two elements come together to make a compound, which can be something entirely different and altogether more formidable than the original underlying elements. For example, in isolation, carbon and oxygen are harmless, but when the two elements combine to form carbon monoxide, we end up with a gas so toxic that it was used as a method of execution by the ancient Greeks. Similarly, when time and inflation combine, they form a very powerful adversary which demands an equally powerful reactive strategy. Here is what Mr. Talwar's current portfolio looked like. Exhibit 64, Mr. Talwar's current portfolio. Assets, house number 1, 250 lakh rupees, house number 2, 150 lakh rupees, loan to developers, 85 lakh rupees, gold 60 lakh rupees, fixed deposit 25 lakh, insurance sum assured 12 lakh, cash 5 lakh, and stocks 5 lakh, total 592 lakhs. Mr. Talwar's portfolio is mainly invested in real estate as he has two houses, one in which he stays and the other which is still under construction, but where the developer has run out of money. Mr. Talwar has only 7% of his investments in financial instruments and 10% in gold. This pattern of investment is unfortunately all too common in India. As per the Housing Finance Committee's 2017 report, Indians hold 77% of their assets in real estate and 11% in gold. Only 5% of the household assets are in the form of financial instruments. Goals. We all have goals, some of which are personal and some of which are for our families. Almost all of these goals carry a financial cost. Our ability to meet those costs become the bedrock of our peace of mind and happiness. Our goals can be bucketed into three categories. One, security. These goals are extremely important to us and provide protection from anxiety. Number two, stability. These goals are not as important as the security goals. However, they ensure that we maintain a desired standard of living. Number three, ambitions. These goals may not be necessities, but they help us achieve upward wealthy mobility and give us certain status in our social circle. Nikhil used the above categorization and helped Mr. Talwar organize his goals. This categorization is shown in Exhibit 65. Exhibit 65, Mr. Talwar's goals in three categories: buying a holiday home, international vacation every year, buying a car every 3 years under ambitions, Ronna's wedding, Akanksha's wedding under stability, Ronna's education, Akanksha's education under security. Mr. Talwar's most important needs are his children's education, security, followed by their wedding, stability. However, in addition, Mr. Talwar has aspirational goals too that seem aggressive ambitions. Specifically, he wants to buy a holiday home in Missouri before he retires, take his family for an international vacation every year, and buy a car every 3 years. These goals cannot be met realistically by the cash flows he is expected to generate over the course of his life. Mr. Talwar is 50 years old at present and, barring lottery win, has only one source of money, his income. Apart from a couple of promotions and a few good years of bonuses in the remaining decade of his career, he does not have anything else to bank on. Given this more or less fixed inflow, the only variable in his financial planning is the rate of return his investments can generate. As explained in Chapter 1, the required rate of return that his investment needs to generate to be able to meet all his goals is a staggering 21% per annum. This was calculated by the financial planning software after taking into account the actual cost of these goals today as well as the impact of inflation on the cost. For example, Akanksha's wedding, which Mr. Talwar reckons can be managed in rupees 70 lakh today, will require an outlay of 1.2 crore rupees in 2024 when it is actually expected. The asking run rate of 21% for Mr. Talwar seems steep, especially compared to the kind of returns he has generated in the past. After accounting for the losses on his real estate investment, his portfolio has only given him an annualized return of 4% per annum since 1990, the year he started working. There was no way he could hope to achieve a 21% per annum return every year. This meant Mr. Talwar would have to amend his ambitious goals. Ultimately, he lets go of his objective to buy a holiday home and reduces the frequency of overseas vacations and purchase a new car to 3 and 5 years respectively. With these changes, Mr. Talwar's required rate of return drops to a more achievable number of 16% per annum. This is what Mr. Talwar's revised goals looks like. Under ambitions, international vacations every 3 years, buying a car every 5 years, stability Ron's marriage, Akanksha's marriage, and security Ron's education and Akanksha's education. Nikhil also helps Mr. Talwar plot his cash flows after considering his future income, expenses, and goals. The cash flows showed a sharp dip after Mr. Talwar's retirement in 2027 since his income stops, but the monthly expenses continue as he expects to maintain the lifestyle he enjoys at present. And why not? After all the years of toil, this is the least that Mr. Talwar expects. Therefore, in addition to generating 16% compounding on his investments, Mr. Talwar needs to invest in a manner which throws off adequate cash flows from the time he retires. Exhibit 67, Mr. Talwar's net worth going forward. To achieve 16% per annum return, Nikhil makes the following asset allocation for Mr. Talwar: equity 80% and debt 20%. This breakup assumes pre-tax 18.8% per annum return from equity and 8% per annum return from debt. The blended return from these asset classes come to 16.6% per annum. With the asset allocation nailed, Nikhil proceeds to help Mr. Talwar figure out what to do inside each asset class. Equity allocation. Nikhil was clear about how Mr. Talwar should participate in equity. He divided Mr. Talwar's equity investments down to three buckets: large caps, multi caps, and small mid caps. The large cap portfolio. Large cap stocks are the anchor for any investment portfolio as these are time tested companies with a long and consistent track record of generating returns for shareholders. Typically, these are the companies that have been around for several decades and profitable businesses which have been through multiple economic cycles. The robustness of these companies means that their share price are less vulnerable in case of a sharp market pullback. This in turn helps reduce the volatility in the overall value of the portfolio. Whilst the definition of large cap stocks is not cast in stone, we view any company with market capitalization of more than 20,000 crores as large cap company. In July 2017, there were 123 such companies listed in the Indian stock market. For investment in large cap stocks, Nikhil choose an ETF. ETFs or exchange traded funds are typically passive funds based on a particular index. For example, Nifty ETF fund has a portfolio which mimics the Nifty and has the same 50 stocks in the same proportion. There are no highly paid fund managers looking after the ETF. This is managed by traders who just have to buy and sell stocks to ensure similarity to the underlying index. Thus, an ETF's performance also mimics that of Nifty. We learned in Chapter 3 that outperformance of large cap mutual funds vis-a-vis the index has more or less vanished over the last decade. ETFs have therefore become the best way to invest in large cap stocks. These ETFs typically have an annual expense ratio of 0.2% compared to the 2 to 2.5% that the actively managed funds charge. The multi-cap portion of the portfolio, Nikhil was clear, had to go into the coffee can portfolio. Mr. Talwar was looking for healthy returns over the next 10 years, as explained in Chapter 2 and in the preceding chapter. A basket of good quality companies which has a consistent track record on revenue growth and return on capital employed almost always beats the index by a comfortable margin. The coffee can portfolio managed inside a PMS can be expected to return 20% annually, while a Nifty ETF should deliver a 15% annualized return over the next 10 to 15 years. With 20% allocation to each of these strategies, these two investments act as a solid anchor to Mr. Talwar's portfolio. Though the coffee can portfolio is expected to give higher returns, the importance of diversification cannot be overstated. Thus, an equivalent allocation to a Nifty ETF will bring down the dependence on a single strategy, however dependable that strategy might be. The small to mid cap portfolio, we define a small cap company as one with a market capitalization of less than 3,000 crore. Some people use the benchmark as a market capitalization of the 400 first company in BSE 500, which is almost the same number. Given that we define a large cap company as one with a market capitalization of more than 20,000 crore, by default, mid caps are the companies with market cap larger than 3,000 crore and less than 20,000 crore. As discussed in Chapter 5, smaller companies have outperformed larger companies, albeit with higher volatility. This is because there is far greater upside possible in a small company than in a large company. The higher growth in smaller companies, however, comes with lower probability of delivering upon this growth. Thus, in a small cap portfolio, an investor is advised to pick up larger number of stocks. This does not mean that he or she should pick up low quality stocks. It just means that there will be some stocks which will be multi-baggers and yet some which will fail to deliver on the promise. As in the nature of the portfolio returns, the winners will end up more than compensating for the losers, The investors buy and leave the portfolio untouched for a long period of time. Nikhil reminded Mr. Talwar that small cap companies have higher volatility and would almost certainly fall more than the broader market in a market correction. However, given Mr. Talwar's 10-year investment horizon, a good small cap portfolio held through an entire market cycle should boost the return of his overall equity portfolio. Nikhil told Mr. Talwar that he could expect a return of more than 20% per annum from his small cap portfolio, whilst the Nifty tracker and the CCP are expected to deliver 15% and 20% per annum respectively. Like in the case of large cap basket, here too Nikhil offered two buckets: mutual funds through the direct scheme route and the good and clean investing approach for small to mid caps. Unlike large cap mutual funds, which have lost the edge they enjoyed over indices, small cap mutual funds continue to outperform their benchmark. The BSE Small Cap Index. The reasons for this outperformance were detailed in Chapter 5. To summarize, there is still considerable information asymmetry in small cap stocks, as these companies are neither well researched by brokerages they nor they in the media limelight. As a result, fund houses can benefit from the large research teams pouring through reams of data, annual reports, management conference call transcripts, newspaper clippings, etc. Remember, there are around 5,000 stocks listed in India, and 4,500 of these are small caps. So, almost by definition, there are a number of hidden gems waiting to be discovered in this ocean of stocks. To Nikhil, it was obvious that investments in good mutual funds should be via the direct scheme route. Nikhil and his firm had seen the writing on the wall 2 years ago and had built their businesses and had built the business model around getting paid by investors like Mr. Talwar for advice rather than being paid by mutual fund houses for distributing funds. Nikhil told Mr. Talwar that he would charge him 1% of his portfolio as an advisory fee every year at rupees 6 lakh annually on a 5.9 crore portfolio. Mr. Talwar found this to be reasonable, considering that Nikhil's interests were totally aligned with Mr. Talwar's. In contrast, had Nikhil been paid by the mutual fund houses through distribution fees, his incentives would drive him to sell the most expensive funds to Mr. Talwar, irrespective of whether that was good or not for Mr. Talwar's financial health. Direct schemes have triggered a revolution from almost zero in 2020 in 2012. Direct schemes now in July 2017 command close to 40% of the mutual fund industry's assets under management. At this rate, it is but inevitable that in the foreseeable future they will account for the majority of mutual fund inflows in India. Exhibit 68: Direct schemes are pulling away assets under management from distributors. Nikhil chose three small cap mutual fund schemes for Mr. Talwar, all with growth options. Growth schemes do not offer any dividend to the investor. As a result, the fund returns even more money when it is eventually encashed, as the dividends are reinvested. For Mr. Talwar, who was comfortably placed with respect to cash flows from his salary, growth schemes made sense. He could always redeem a portion if he needed any capital. Nikhil reminded Mr. Talwar that long term capital gain tax on all equity investments was zero. Next up was the good and clean investing approach for small mid caps. Since there are over 4,500 small cap stocks in India and very few of these companies are well researched, smaller companies' promoters are notorious for their propensity to fabricate financial statements. Leaving aside their cleanliness with regard to accounting and corporate governance, most Indian companies struggle to invest their capital sensibly because promoters rarely follow a specific strategy for extended periods of time, and because the ability to execute day in, day out, month after month, year after year is a discipline that very few Indian management teams have mastered. Nikhil explains to Mr. Talwar how Ambit's good and clean construct helps identify high quality companies using a set of highly effective filters. The good and clean framework. There are two filters that run on the whole universe of stocks. First is good. This helps in identifying stocks that have done a great job in creating shareholder value, right from judicious capital expenditure to profitability and to return of surplus cash to hold shareholders. Number two, clean helps in identifying how good the company's corporate governance is and what the quality of the published account is. It is a measure of the long-term sustainability of the company and its performance. The focus on good helps generate the upside while not compromising on clean reduces the downside risk. One cannot overemphasize the value of limiting the downside. Exhibit 69 shows the extra amount of upside that a manager needs just to make up for the downside phase. For example, after a 50% downside, a portfolio manager has to give a 100% performance just to get back where he began. And that is why Warren Buffett's famous two rules on investing are: rule number one, never lose money; rule number two, don't forget rule number one. Exhibit 69, you need more upside to make up for the downside. Exhibit 17, good, the greatness framework. As shown in the preceding exhibit, the good framework essentially hinges on using publicly available historical data to assess which firms have, over a sustained period of time, been able to relentlessly and consistently invest capital, turn investment into sales, turn sales into profit, turn profit into balance sheet strength, turn all of that into free cash flows, and invest free cash flows again. All of these parameters are calculated quantitatively using the factors listed in the exhibit below. Exhibit 71, the greatness factors. Clean, the accounting framework. The framework checks for the quality of companies' accounting using 11 ratios. Exhibit 72, accounting checks. Category P&L misstatement, ratios, cumulative CFO, cumulative EBITDA, volatility in depreciation rate, volatility in non-operating income as a percentage of net revenues, provisioning for doubtful debts as a portion of debtors more than 6 months. Then balance sheet misstatement check. It includes cash yield, change in reserves, excluding share premium to net income, excluding dividends, contingent liabilities as a portion of net worth. Then pilferage checks, which include miscellaneous expenses as a proportion of total revenue, CWIP to gross block, cumulative CFO plus CFI to median revenues. Then audit quality checks, CAGR and auditor's remuneration to CAGR in consolidated revenues. Exhibit 73 highlights the importance of cleanness check. If we rate the BSE 500 companies on the basis of cleanness and divide them into 10 groups or deciles, data shows that the companies with the worst scores, that is, the least clean companies, gave the worst return to the shareholders. Exhibit 73, the three zones on accounting quality. The debt allocation. With the equity allocation nailed down, 20% in an FT tracker, 20% in coffee can PMS, 20% in small cap mutual fund, and 20% in a good and clean PMS. Nikhil and Mr. Talwar now move on to discussing the allocation of his debt portfolio. Here, Nikhil cautioned Mr. Talwar to not expect very high returns. He explained to Mr. Talwar that debt was like the non striker in a batting partnership, somebody who will hold the other end while the big hitting and running will be scored by the striker, which is equity in this case. According to Nikhil, it was a no-brainer to invest in mutual funds for one's debt allocation. Mr. Talwar, who had never looked beyond fixed deposits, wondered why. Nikhil explained that taxation benefit that debt mutual funds, that is mutual funds that invest in bonds issued by the government and by corporates, enjoy over all other bonds and fixed deposits. While debt mutual funds are subject to long-term capital gain taxation of 20% with indexation, long term is taken as 3 years, returns from fixed deposits and bonds are taxed fully on the income tax rate. Given the way indexation works, the mutual fund's effective tax rate works out to be anywhere between 5% and 15%. Thus, if a bond and fixed deposit both give 9% pre tax returns, an investor may get only 6.3% post tax return with a fixed deposit. The same investor with the same 9% pre tax return can get 8.1% in the mutual fund because of what amounts to 10% capital gain taxation. In other words, the investor ends up getting approximately 30% more on a post tax basis if he takes the debt fund route. That said, Nikhil mentioned that investors need high quality advice in order to be able to choose the right debt funds. Given the role of debt in a portfolio, the safety of capital should not be compromised for a few basis points of extra returns. Mr. Talwar had heard from his friends that about some debt funds which gave industry beating returns. Nikhil then explained to him the fallacy in rewarding performance in a debt fund. A debt mutual fund's return is a function of yield to maturity, mark to market, and expense ratio. In its most simplest form, debt mutual funds return is equal to YTM plus MTM minus expenses. MTM is the return that a fund manager generates as a result of appreciating on bond prices. Remember that a debt mutual fund is a collection of government and corporate bonds. This change in bond prices is in turn a function of the movement in interest rates. Mutual funds in India manage more than 11 lakh crore rupees of debt assets, and each of these funds has access to similar information sets. Hence, it is almost impossible for any debt fund manager to consistently outperform the peer group. MTM returns over a period of several years are therefore similar from all debt funds. In a given class of debt funds, example short term bond funds, liquid funds, that leaves us with the YTM and the expense ratio. By now, you are familiar with the expense ratio. It is the fees you knowingly or unknowingly pay to the fund management house. So let us focus on YTM. The yield to market or YTM of a mutual fund is a weighted average yield of all its investments. The yield of a mutual fund depends on the credit quality of its portfolio. If you are interested in investing in debt funds, you need to understand this relationship between credit quality and YTM. All corporate debt is rated basis the quality of corporate's financial statements. These ratings are provided by rating agencies in India, including CRISIL, CARE, ICRA, Indian Ratings, and BRICFOX. Each issuer of debt gets a credit rating on the basis of its balance sheet strength. For example, government securities with the highest credit strength get a rating of AAA. Similarly, a struggling company with a poor debt management may get a rating of B. A rating of D means that the company has defaulted on its debt. Based on these ratings, we assign a unique score to each rating company. For example, government securities get a score of 10, AAA papers get a score of 9, AA plus papers get a score of 8.5, and so on. We then multiply the weights of these different papers in a given debt fund with the respective scores to arrive at the credit score for each debt fund. Once the credit score for each fund are calculated, we plot the YTM versus the credit scores for all short term debt funds available in the mutual fund universe. See exhibit below. Exhibit 74, high inverse correlation between credit score and yield to maturity of debt funds. The inverse correlation of 92% shows the strength of the connection between credit score and YTM, implying that higher returns given by higher performing debt funds are largely a function of the extra credit risk that the debt fund manager is taking. In other words, the single factor that drives higher YTM appears to be the higher credit risk. Thanks to this knowledge, Mr. Talwar has understood why he should choose debt mutual funds on the basis of the quality of the portfolio rather than the historic returns given by these funds. Mr. Talwar's final portfolio. With all the bits of portfolio now in place, Nikhil laid out the final investment plan for Mr. Talwar. See the exhibits below. While it was a long-term plan, it needed periodic monitoring, which Nikhil would do along with Mr. Talwar. Exhibit 75, proposed portfolio allocation for Mr. Talwar. Equity large cap, multi cap, large cap ETFs, coffee can portfolio 20%. Mid cap, small cap, mutual fund, good and clean portfolio 20%. Debt short term mutual fund 20%. Grand total 100%. Pre tax return 16.6%. Post tax return 16.5%. At this point, Nikhil reiterated the importance of low cost funds, ETFs, and direct schemes. As a comparison, he calculated that Mr. Salwar's pre-tax returns would have fallen to an annualized 15.6% from 16.6% shown in the exhibit above had he invested in regular schemes with higher expenses. Dusk was enveloping Noida, and Mr. Talwar's relief at being able to rationally plan his financial future was such that he brought out a 20-year-old single malt he had saved for a special occasion. After Nikhil and he raised a toast to his long-term financial security, Mr. Talwar turned on some music, Kishore Kumar's greatest hits from 1970s, and stretched out on his favorite couch to relax.